Canadian investors holding U.S. rate-sensitive assets should note Fed President Warsh's push for fewer policy meetings, which could stabilize borrowing costs across borders. This is Modern Investing Techniques, episode 124. Quick reminder, everything we discuss here is for education and entertainment. The practice investment of the day uses simulated trades with no real money. I'm not a licensed financial advisor, and this isn't financial advice. Always do your own research before putting real money to work. The S&P 500 closed at 7,490, up 0.7%. The NASDAQ Composite closed at 25,374, up 1.0%. The TSX Composite closed at 35,226, down 0.8%. The Fed held its benchmark rate at 3.5 to 3.75% for the fifth straight meeting. President Warsh floated reducing the standard 8 annual gatherings, a shift that could lengthen the current easing cycle for both the Fed and Bank of Canada. The Dallas Fed trimmed mean PCE printed 1.4% annualized in June, its lowest since 2020. Remember, we covered DAL about 22 days ago on an earnings surprise entry with record revenue and margin resilience despite peak fuel costs, and it closed down 1.41%. Portfolio performance data, including cumulative return, year-to-date return, and alpha versus the NASDAQ, is not available in today's briefing. Now let us turn to the core skill of managing defined risk trades in this same policy environment. Credit spread selling lets investors collect premium while defining risk. Exits must be mechanical to avoid emotional overrides. Today's mixed signals from lower inflation prints and geopolitical headlines make rules-based exits especially relevant for Canadian accounts that already face currency and rate volatility. The straightforward rule is to exit any credit spread once the loss equals 100% of the credit originally received. A $13 credit therefore triggers a stop at $26. This approach removes discretion and works on any platform that supports options, including Questrade or Interactive Brokers. It has historically performed best in range-bound or slowly trending markets where premium decay outpaces small adverse moves. Yet it can still lose when volatility spikes suddenly. Always size the position so a full stop out equals no more than 1% of portfolio capital. The rule applies equally to vertical spreads on individual equities or index ETFs. It pairs naturally with the current environment of contained PCE readings that suggest limited immediate rate cut pressure. Canadian investors using TFSA accounts can implement the same stop discipline without triggering frequent trading concerns because the rule is purely mechanical. That mechanical exit pairs directly with the next step of selecting a name that benefits from the same policy signals. This is a simulated trade for educational purposes only. No real money is involved. This is not financial advice. Today we are monitoring JPM in the financial sector. The catalyst is Warsh's discussion on fewer annual rate meetings, which could extend the current policy path and support bank net interest margin stability. The 1.4% annualized Dallas Fed trimmed mean PCE for June marks the lowest reading since 2020. That print aligns with the 5-year low 2.2% 12-month increase, giving banks more room to maintain spreads without immediate policy reversal pressure. We are watching for a daily close above the 50-day moving average with volume at least 10% above the 20-day average. Current levels show support near recent lows. Geopolitical headlines could widen credit spreads and pressure financials. The stop loss is set at 6% below entry to cap single trade loss. The target is plus 2% to plus 5% over the 5-day window if volume confirms and rates stay anchored. Confidence is medium because two macro factors align, but sector breadth remains uncertain after the semiconductor sell-off. This setup demonstrates waiting for volume confirmation on a macro catalyst rather than jumping on the headline alone. Listeners learn to map central bank language directly to sector balance sheet impacts instead of guessing direction. No newly closed trade since the last review. The most recent practice investment remains open and pending its scheduled evaluation. There is no new realized result to report today. The weekly video from the Fidelity In the Money Options series breaks down current market signals into 2 concrete trade ideas each episode. It uses Fidelity's options chain and probability tools to show real-time implied volatility skew and payoff diagrams. Canadian investors can replicate the setups inside Questrade or Interactive Brokers by importing the same strike and expiration logic. The series also walks through position sizing examples that tie directly to the credit spread stop-loss rule. Access the latest episode free on Fidelity's Learning Center. A CNN poll shows 74% of Americans report gas price hardship. Rising fuel costs are squeezing household budgets, a direct input into both CPI and consumer discretionary spending. Trim consumer-discretionary ETF exposure if crude closes above its 50-day moving average this week. Ballistic missile strikes by Iran's IRGC on U.S. facilities in Jordan raise the geopolitical risk premium on energy and defense names. The direct targeting of a CENTCOM-linked facility adds a new layer of supply chain uncertainty for global energy flows. Add a 2% position in a broad energy ETF only if the next daily close shows volume 20% above the 20-day average. Citi flags a $52.5 billion peak in Korea-linked leveraged ETFs. Retail leverage in Korean assets crested in June and has since unwound sharply. Avoid new positions in single-country emerging market ETFs until the Kospi stabilizes above its 200-day moving average. Treasury Secretary Bessent's Camp David note reveals a $5 to $10 billion yen purchase plan. The range outlined provides a concrete scale for any intervention that could alter USD JPY volatility and affect cross-border equity flows. Hold CAD cash rather than adding unhedged Japanese equity exposure until the USD JPY pair closes below 145. Portfolio performance data is not available in today's briefing, so we cannot update win rate or year-to-date alpha here. The simulated record continues to serve as a learning artifact rather than a track record to follow. Now here is something most retail investors get wrong when an earnings report lands. Imagine you bought a U.S. industrial name last week after an analyst raised estimates. Your order filled at the open, but the stock faded 4% by midday. The actual driver was not the headline EPS beat, but the widening gap between reported revenue and free cash flow conversion. Revenue shows top-line growth, yet EPS can be flattered by one-time items or share buybacks. Always subtract non-recurring gains and check the cash flow statement for rising receivables or inventory. Forward guidance matters more than the beat itself. Management commentary on margins and CapEx often signals whether the beat is sustainable. Free cash flow yield above 8% combined with an earnings beat has historically preceded multi-quarter outperformance in rate-sensitive sectors. The common retail mistake is treating any EPS beat as an automatic buy signal. The fix is to read the 10Q cash flow section and the forward paragraph before adding to a position. Compare year-over-year changes in operating cash flow versus net income to spot non-cash earnings inflation. When management raises full-year guidance after a beat, the transcript usually contains the precise language on whether the improvement stems from volume or pricing power. Investors who skip the balance sheet footnotes often miss rising contingent liabilities that later pressure valuations. The practical sequence is to open the earnings release first for headline numbers, then the 10Q for cash flow reconciliation, and finally the prepared remarks for forward color. Before we wrap, open your brokerage platform, pull up the options chain for any financial name you already own, and note the 30-day at-the-money straddle price. Divide that premium by the stock price to see the 1-month implied move you are paying for. Tomorrow, we will examine how the latest yen support signals could shift cross-border flows into Canadian energy names. That's your modern investing techniques for today. Subscribe, leave a review, and we'll be back tomorrow with more market intelligence. And if you'd rather watch than listen, find us on YouTube at NARA Network. Links in the show notes. And before you go, this show is part of the NARA Network, a family of daily podcasts on tech, science, and markets. Each one a short, sharp briefing you can finish on the commute. If today earned its place in your feed, here's your next listen. First Principles Daily, reasoning from raw materials, not analogy, on the breakthroughs that actually cut cost. Find every show free at naranetwork.com. And on the website, every episode's visuals live in our free image gallery at naranetwork.com/gallery. Royalty free under Creative Commons, download with attribution. This episode used AI voice synthesis of my voice. Editorial selection and analysis are my own.
Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous? Do you ever stay awake, counting sheep like all the time? What's your life like? What's your purpose? When's your birthday? What's your sign? Are you down right now? Are you stuck up in the past? Are you still thinking about all the times that you didn't last?